Sarah Hunt, Alpine Woods Portfolio Manager, and out there on the left coast, Los Angeles, Ken Shinoda, Doubleline Portfolio Manager, joining us here for the conversation. And I'll start off with you, Sarah, of course, with the caveat that, of course, one data point does not a trend make, but 235,000 jobs certainly has to raise some questions.
Well, I think that everybody was expecting some sort of a slowdown, since we had a script that we were going to get through this pandemic, we were going to have it reopening, and everybody was hiring for it. Then the Delta variant came in and changed that. So I think everyone looked at July's numbers and thought, okay, August is going to be weaker, but I don't think that they were expecting it to be that much weaker. And I know that there were a lot of particular things about this jobs report. There was some education jobs that people expected that didn't come in. So we're also going to have to see what September says, but September is likely to be noisy as well, as people start to get back to school if they can, and people start looking for jobs if that's part of the reason it was being held up.
Yeah, and Ken, not only did that headline number miss to the downside, there was also a big miss to the upside with regards to that wage growth.
Yeah, I mean, what you're definitely seeing is a supply-demand imbalance between the job openings. We have, if you look at the JOLTS data, over 10 million job openings relative to 8.4 million or so unemployed. People want to hire, companies and businesses want to hire, but the fear of the Delta variant, some pandemic-related restrictions, people are kind of hesitant to go into the workforce. So what you're seeing is that companies have to offer more to get potential employees to come back into the workforce. And so you're seeing hourly wages start to sneak up.
When you look at some of the data that we saw in this report, Ken, specifically with regards to that wage data, and you overlay that with sort of a stagnant labor force participation rate, do you worry at all about, I guess, what this means for inflation, deflation, or maybe something in between?
Yeah, look, different people can look at the data, slice it different ways, and come to different conclusions. I mean, one of the reasons you saw a spike in hourly wages earlier on during the pandemic was that the lower end wages in hospitality and leisure kind of fell out of the workforce, and so you saw a spike there. So there are those that will tell you that these wage increases have things to do with those types of trends, but I think there's, pre-pandemic, we had a long era of slack in the labor market, and that's kind of what kept inflation at low levels. And the big question now is some of that slack permanently gone, with certain parts of the workforce dropping out? If you look at the over 55 cohort, that cohort has really not come back into the workforce, and some of them may never come back because of what's going on right now with the pandemic.
And of course, Sarah, sort of a lot of the reason why the market, of course, parses what's in this report is more so because they're trying to parse what the next steps are going to be for the Federal Reserve with regards to that taper, and I guess potentially at some point with regards to rate hikes.
Absolutely. And I think that this is one of the big questions where people were looking at the timing and saying, okay, is this going to push this a little bit further? I think it does, but there were some people who didn't think that we were going to start until December anyway. So it's a little bit, I think the taper is going to come. They've been very quick to try to separate taper from rate hikes. I think the expectation will be that once the taper starts, the next thing on the table will be rate hikes, but it really depends on the development of the economy. And to the extent that there's a mismatch between the jobs that are trying to be filled, as I talk to a lot of companies that can't fill jobs on this certain skill set levels, and maybe some of the changes after the supply chains have been messed up after COVID for the first time, you're starting to see people open up things in the U.S. and manufacturing that we didn't have before. I think there's a mismatch there.
The reaction in the market today, Sarah, on Friday, it was relatively muted. You did see a bit of a sell-off in some areas of the equity market, and you saw, I guess, a slight steepening of the yield curve in the bond market here. What do you think is going to be the reaction? Should, I guess, this type of data become a trend? So we start to get more than one sort of weak data point here. Do you think there will be a significant change in the positioning that we're seeing in the market?
Well, I think in the first instance, if you start to see repeated data points that are weaker and it looks like the employment picture is starting to really slow down, and that's not just a blip because of Delta, then I think that you push out the entire tapering and rate hike cycle. And I think that to the extent that that's good for the equity markets that like low rates on the tech sector and everybody else, that the market itself and equities can perform fairly well in that environment. But you do start to see a move around in positioning. That should not be so great for the cyclicals. It should not be so great for the companies like the banks that would like a different rate structure than we see today, or at least a little bit of a steeper yield curve. You saw a little movement in that today, but I think that you will start to see some sector repositioning if it looks like we're really seeing a slowdown in growth and it's not just a short-term slowdown.
Well, so Ken, what would that mean for a fixed income manager?
It's interesting. When you say the word taper, the initial reaction of most investors is that if they're not going to be buying bonds, then rates should actually be going higher. But if you go back through time and look at what actually happens, when quantitative easing starts, the yield curve actually steepens. And when outside of the Operation Twist, where you saw long-term rates fall, when quantitative easing occurs, you see rates rise, and tapering actually lowers interest rates as the market starts fearing that growth will slow without accommodation, and or the Fed has their arms around inflation. The big question to me is this time different?
We also saw, Ken, this week, the dollar weekend. It was down for 4 straight days, at least as measured by the Bloomberg Dollar Index. And you really haven't seen any sort of a meaningful move higher or strengthening in the dollar now for at least a couple of weeks here. There's been a lot of talk here about, at least at the start of the year, about the direction of the dollar. And at the end of the day, it hasn't really done a whole lot. And I'm wondering how much of that factors right now into your investment outlook. How much of that are you worried or concerned about?
Well, from a fixed income standpoint, if you're a dollar-based investor, you're not terribly concerned. But if you're looking at, emerging markets or other dollar-denominated assets, it's something definitely to take into consideration. The dollar has been going sideways, but I think with the last Jackson Hole, with the Fed basically telegraphing that while they'll taper bond purchases, that they're going to keep short-term interest rates very low. That's kind of in contrast to, let's look at over in Europe. ECB a little bit more concern about inflation. They may hike rates sooner than we will, which is why you've seen the dollar start weakening. So that, to me, says maybe some of these non-dollar denominated investments may look attractive. Curious to see what Sarah has to say about that.
Yeah, I'd like to hear your thoughts too, Sarah.
Well, it's interesting because for some companies, a weaker dollar is better. And for some, and it really depends on the sectors and it depends on where your sales are. So to the extent that it may be an issue for some companies to have a weakening dollar because their purchasing power is weaker, it's very good for people who are selling stuff in other places because it makes things cheaper for them. So I think we're going to have to see how that goes. I know that Europe looks like they are starting to sound a little bit more aggressive on that. I'm not sure that they really end up in the end can be sort of in a similar position that we're in, but we'll see how that happens because we do have an ECB meeting coming up this week, next week.
All right, well, both of you are sticking with us in conversation right now. Sarah Hunt of Alpine Woods and Ken Shinoda of Doubleline. Coming up, we're going to have Ken Shinoda, portfolio manager at Doubleline. Ken, I want to come back to you here and really on the idea of what we've heard out of Jay Powell, what we've heard out of the Fed here. A week ago, we were talking about, of course, his speech at Jackson Hole, where he talked about the substantial progress that was, I guess, sort of made on inflation and that he saw substantial progress being made, of course, on the labor front. I am curious how satisfied you are so far with some of the communication that we've gotten out of the Fed and the other policy numbers.
Yeah, great question. I was driving over here and I was thinking about the amazing tools that the Fed has created for themselves over the last decade. I have an analogy about the Fed, call it 20 years ago. It was like a 2-speed manual transmission. It was either rates low, rates high. And now, after a decade after the global financial crisis, you've got quantitative easing, you've got Operation Twist, you've got all the programs they can throw out like TALF and TARP during times of crisis like March of 2020. They've got the dot plots, and now they've got talking of taper. So they have so many ways they can slowly navigate the markets and keep confidence by the investment community by slowly either moving the dots, taking away some language around accommodative and taper and so on and so forth. So for now, just look at where the equity markets are and look where the calm and the fixed income markets. So far, they've been doing their job, it seems.
Yeah, that proverbial toolbox has certainly been put to use. So, Sarah, I want to get your thoughts on that as well. I mean, everyone's talking about tapering, but of course, as Ken points out, there are a lot of other tools that the Fed has, presumably, to manage monetary policy.
Well, first, I just want to say that I love that analogy, and then I have to figure out what it is now. If it was a 2-stroke engine before, what is it now? I think that there is a lot that they can do. I think that they were forced to do a lot because they couldn't, prior to recent history, we couldn't get a lot of fiscal stuff going, and that wasn't just here, it was in Europe as well. So I think that the monetary authorities have been leaned on pretty hard in this, between the financial crisis and then every crisis that's come afterwards. So I think that there are a lot of tools, and that makes that question about taper even more interesting because then it becomes, okay, so you could taper and then you could pause for a while too. And I think that that's sort of where the equity markets are expecting, which is why they haven't reacted so badly. And I think that there's more room for them to do stuff than just go in one direction and then reverse and go in the other direction.
This, of course, also raises a lot of questions here about Powell's future. Of course, his term is coming up. According to Bloomberg reporting, there is expected to be some sort of announcement about a potential renomination here of Jay Powell by the Biden administration here. There's some pushback as well. Some folks maybe think that the Biden administration should turn to someone a little bit more progressive. I'm wondering how the market would react to a situation where Jay Powell was not in that Fed chair come next year.
Well, I think that would be sort of tricky because I think the markets like continuity in the sense of they understand what's happening, especially after a presidential election. So I'd be surprised if there was that much of a shift that quickly.
Ken?
Yeah, I agree. Janet Yellen's already come out pretty positive on Powell, and I think steady as she goes right now, given other things going on with the administration, is probably the path they'll take.
All right, I want to switch over to fiscal policy because, of course, that's also going to play a big factor here in the Fed reaction function, Ken. There's $4 trillion worth of fiscal spending floating around out there in Congress right now. About $3.5 trillion of that, some folks think should be put on pause, including Senator Joe Manchin, who pretty much came out this week telling his party that he's probably not going to support that.
2 trillion, 3 trillion. I mean, right now it seems like why stop there? Powell, during the heart of the pandemic, called March, April, summer of 2020, was pretty vocal that in order to get this economy, off the ground again, we need to have that fiscal stimulus come in, and we've had it come in. And right now, I guess the bigger question for risk markets is the market addicted to it? Will the consumer truly rebound, or will they continue needing the stimulus checks? Will they continue needing the fiscal support to get this economy continuing on a positive trajectory?
And of course, we're having this debate when a lot of those expanded unemployment benefits are set to expire basically the day before Labor Day. Sarah, there's, I guess, an argument to be made as to how much this type of fiscal spending and these other sort of ancillary types of support are supportive of the economy as a whole. I'm curious as to how supportive you think these measures have been of the stock market, of the equity market, and other financial assets.
Well, I think it's been very helpful for the equity markets. I think that to the extent that we're now about to get rid of some of those extended benefits, if you look at what happened in this recent labor report where you had no jobs added in the leisure and restaurant industries, I think that's an industry that is still very much in trouble. And I think that that's an industry that still very much could use some support. It's difficult because sector by sector, there are some sectors that do not need it as much. But I think that the market has liked the spending that's come about from people having the excess income. And to the extent that they can't get a job, for some people, it's not excess income. It's the only thing that they can get right now. So I think that there is going to be, that's why I think September and October jobs reports are going to be very interesting, and how the other economic data that comes in on spending and everything else over the next couple of months to see how much of an impact that actually had on some of the data.
Well, baked into those spending proposals, of course, are some more longer-term initiatives, Sarah, on infrastructure, hard infrastructure, as well as sort of expanded infrastructure type projects here. I'm wondering that if that money were to actually be passed, be signed by the president, and actually make it into whatever avenues are going to be taken into the economy here, whether that changes at all your longer-term outlook, your longer-term positioning within risk markets itself.
Well, I think that we need some infrastructure spending. I think that the recent hurricanes just show that so clearly, and what's happening to New York City with all the flooding show that very clearly. If you get that kind of backdrop for certain parts of the infrastructure series, that's a great place to be. It doesn't change risk appetite longer term as much as a change in interest rates and interest rate structure and global growth would change the risk and the equity picture. But I think that to have an underpinning of some real infrastructure spending that we have been talking about now for a decade and a half and still haven't actually put to work. I mean, you can see a lot of construction happening, but you're not really hardening out the grid. You're not really doing the kind of things that you need to do if you want to change over from a carbon economy and do some of the things that we're talking about on the ESG front. You really need to do a lot more work on the infrastructure in the United States, and that would certainly put some sectors in a very good spot if you could get funding to do that.
Ken, I want to get your thoughts here about the housing market, because this has actually been, at least for a while, one of the bright spots here during the pandemic, and unfortunately is now becoming one of those parts of the economy that a lot of people are worrying about, the sustainability of the boom in the housing market and, of course, some of the inflationary aspects of the housing market. How do you view the situation right now?
Yeah, I mean, look, the housing market is very strong, and it's being driven by a couple main factors. One is existing inventory of homes for sale and new homes for sale. We haven't really been building single-family homes since the global financial crisis. We focused a lot on multifamily. So even going into the pandemic, the inventory of available homes for sale was at historically low levels. After the pandemic, a rush to flee the cities into the suburbs, and then inventory dropped to even lower levels. New home sales are starting to pick up. New home building is starting to pick up. There is some kind of supply chain issues there related to the cost, the materials, also the cost of land and labor is up. But that low inventory is really what's been driving home prices up, along with low interest rates. Mortgage rates are at historical lows, and put those two things together, and it's a recipe for higher home prices.
All right, we're heading into a 3-day weekend, the Labor Day weekend here in the United States. Ken, post-Labor Day, that was supposed to be the back to school, back to work. It was supposed to be the revitalization of a lot of these business districts. When you look at commercial real estate out there, which has suffered pretty badly during the pandemic here, do you see any sort of hope, at least in the interim?
Yes, I drove from the suburbs into downtown today. Our offices as well, post-Labor Day was the game plan, but with the Delta variant, I think a lot of companies are starting to push back that back-to-office effort. And I think that commercial real estate is a very bifurcated market. Certain pockets are very hot. Industrial is like a rock. E-commerce is in demand right now. Multifamily is also largely like a rock. A lot of borrowers making their payments or tenants making their payments. Retail was bad going into COVID. It still has troubles. So really kind of the two main spots are the ones that have to do with business-related travel and the office. Leisure-related hospitality, people want to go on vacation, they're doing okay. But the big uncertainty really is commercial office space and business-related hotels. And really the jury's still out, and it's kind of wait-and-see mode right now.
Sarah, do you have an eye at all on what's been going on, particularly in the real estate market, whether it's with the housing market or with commercial real estate? Anything there that you've been keeping an eye on?
Well, I would agree with the sectors that your other guest just mentioned were very strong, and I think that's something that's going to stay where it is. It's hard to imagine that we're all going to go back to work in lockstep very, very quickly, and or that a lot of people aren't going to want to continue to work from home. So I think that the real question is going to stay on that business and commercial sector. And I think, you can add to that some of the things like business travel and airlines hasn't recovered at all, and airlines haven't recovered. So there's a lot of areas that are going to be much more continuously negatively impacted by the fact that where people are more used to working from home, and in a lot of places, that means that you've got some areas that are very tricky to figure out what to do with.
All right, wonderful conversation here. Sarah Hunt, Portfolio Manager with Alpine Woods, and Ken Shinoda.